breaking it down, no need to stress. Clearing the path to your financial success. From policies to plans, they've got to know. Sharing the secrets so your wealth can grow.
Alors, merci de prendre le temps de regarder le podcast. En passant, toute l'information que nous donnons aujourd'hui, c'est à titre d'information. Ce n'est pas une recommandation financière. Pour information additionnelle, on vous suggère de nous contacter personnellement pour d'autres informations, pour savoir qu'on peut aider de façon personnelle.
Chacun de vous a des choses différentes. Alors, on veut être sûr que qu'est-ce qu'on va vous donner comme conseil, ça va être spécialisé pour vous.
Par contre, n'oubliez pas une chose, très importante à faire uniquement avec les gens de l'Institut national. Tenez, on est vraiment l'expert dans le conseil.
Bonne écoute. Bonjour et bienvenue chez Contrôler votre richesse financière. Moi, c'est Anthony.
Moi, c'est Farideh.
Et moi, je suis Jean-Pascal. Aujourd'hui, événement spécial, deuxième anniversaire de notre événement Santé, Prospérité, Richesse avec Dr. Zarouk. Ça va être excellent.
On va parler aujourd'hui de l'infinite banking et également la santé. Dr. Alexandre Zarouk va parler sur la santé de la thyroïde. Alors, viens avec nous et on va commencer. One, good morning. Bonjour, my name is Anthony Pascal.
Et moi, Jean-Pascal Martin, but they call me Jay in English.
So we want to welcome you to our health and wealth seminar that this is our third.
Yes, exactly.
Our third health and wealth seminar. So we want to thank our partners that are here with us. Number one is Orange Theory Fitness, because without health, we don't have wealth. So go see the booth at the back, register. They have un tirage qu'ils vont faire pour je pense que c'est 10 classes gratuits avec un sac, une bouteille d'eau. So go check out Orange Theory Fitness because it's really important. I go there. I've been going there since 2018, and it's a really good workout if you want to get 1 hour in, 1 hour out. And it's also good because Manulife, if you buy insurance, they actually have a special deal with Orange Theory Fitness. Yeah. So there is a reason why we have Orange Theory Fitness with us. And Manulife Bank, of course, our sponsor for the Manulife One. So if you never heard of Manulife One, well, you need to know about it. Bernie's going to come up and speak about it later on today, so you'll be able to understand what the Manulife One Bank is. And also Berkshire Hathaway Home Services Quebec for your real estate needs. We are partnered with Berkshire Hathaway Home Services Quebec, and Sacha Brosseau, the CEO and president, is here today. He will just speak about the real estate market. So thank you to our sponsors.
So today we'll have an opportunity to talk about the infinite banking concept. But one thing is important to understand, we're not going to talk about banking itself, right? It's more of a strategy. And one thing that's important to mention also is that this is more about, it's not personal advice. So like anything else, we have to put a disclaimer on. We're going to say, this is not personal financial advice. You need to talk to a professional first, right? But we believe that this concept actually can really change or propel your finances also for those who take the time to really learn it, right? Mm-hmm. So obviously, this is just an introduction of the concept itself. But that's on that, you should do a 10-hour seminar to talk about the system itself. So don't worry if you don't catch everything the first day. It's normal, right? But just stay with it, continue your education, and you'll be happy actually that you did, okay?
So, infinite banking. So as we talked about Berkshire Hathaway Home Services, who knows who Berkshire Hathaway is? Yes? Who's Berkshire Hathaway? Warren Buffett, right? And so why did we join forces with Berkshire Hathaway Home Services Quebec? So the reason why we joined is because we like the way Warren Buffett thinks long term. Why? Because he thinks about, his company's called the Forever Company, that's the slogan they use, because he thinks about value. He's not looking about making that quick dollar right now. Everybody's focused on putting my money in the market to try to make the biggest return or buying crypto to get the biggest return, but Warren Buffett doesn't work that way. He says, let me think long term. And as a matter of fact, traditional financial advice doesn't actually teach you how to think. They make you think 5 years, 10 years down the line. But really, you should be thinking about 2 generations, 3 generations, like the wealthy think, right? And so that's why we talk about, think about your wealth differently, because a lot of us are like a tractor that runs along a fence. You know, when the tractor in the farm keeps running on that same path back and forth for years, it creates what? Those wheel ruts that the wheel gets out. And it's hard to get the tractor to come out of that because you're so used to doing that path back and forth. What we want you to think about today is like jumping out of an airplane with a parachute. You open that parachute and gather all the air in that parachute. So just gather the information, because we want you to think of wealth differently.
But we do believe that those who spend their time to learn about infinite banking concepts will enrich their lives. So the same way that Warren Buffett talks about longevity, the forever company, we think also this is going to be the forever strategy to implement within the generation also, okay?
What is true wealth? Well, wealth is having abundance in all these 5 areas. So personal, which is basically on your time, what you spend on time, on your health and your mindset. That's why we talk about health and wealth, because you need some health in order to continue, right? Family, what's the relationship with your family, your friends, your colleagues at work? Financial, which is how does money work? Understanding how money works. Occupational, it's basically who, not how. A lot of us focus on how do we do things instead of finding the person who can help us do the things right. And then finally is the purpose. What was your purpose, right? What would you do if money was not a concern? Now, today we're not going to go through all 5 areas. We're going to focus mostly on the money, and then later we're going to be talking about your personal health. Because without health, okay, even if you have all the money in the world, there's nothing you can do. But then the opposite is true. If you don't have wealth, but you have all the health, then you get stressed. Because now money is a cause of stress and causes your health to deteriorate. So it's important to have both and balance both. How many of you have read this book? No. 1, 2, 3. Okay.
Excellent.
Nelson Nash created that book. He wrote that book because he used to start with a 10-hour seminar where he used to gather people to speak about infinite banking. But now you can read it in a 94-page book, which is actually, the majority of it is pages of illustrations and stuff, but you can actually read the concept in 54 pages. So it's a very quick read to understand the concept.
Anthony and I were financial advisor since 2010 and 2015. And like everything else, right, we learned to do things a certain way, right? And then even the industry wants us to teach you how to manage your money a certain way too. What is it? All right? Buy a house, pay as soon as possible, put some money to RSP, let's say for your retirement, right? CSFA sometimes, let's say for vacation or everything, and buy a bit of term insurance, right? So that's the way that most financial advisors are guided to teach you how to manage your money, right? But then we have to learn a different way. And today, we're going to show you how to do things differently, okay?
Now, when Nelson Nash used to start his seminars, he used to start with this phrase. You see, it's all about how you think. It's all about how you think. It's all about how you think. Now, why do you think he used to start this seminar with that?
Which means your perception determines your reality, right? So the way we spend time to refine our thinking, it becomes important. Because we think about it, okay? How many times do we rethink about our thinking? It's not weird, I would say that. Think about your thinking, right? But it's important to do it. Yeah, exactly. Because again, whoever is actually influencing you is guiding you suddenly, right? So it's important to spend the time to really reevaluate things. And just like I mentioned earlier, us financial advisors also have to rethink our thinking when it comes to money as well. Because something we realize is that if only a minority of people are wealthy, what we do what most people do, right? It doesn't make sense. So why don't we do what they do instead? But then we have to learn how they do it, right? So when we start to spend time to study what the family office do, what the wealthy are doing, what the top 5% of the population do with their money, right? So you start to realize, oh, it's a different ballgame here, right? It's not about money locked in. It's about accessibility, control, and cash flow, right? So the infinite concept, as Nelson Nash used to call it, Nelson not call it infinite because you can't put boundary to infinite, right? But what's important to mention is that infinite banking has nothing to do about controlling the return on your investment. It has everything to do about how you finance the things in your life, right? Because most people, when it comes to money, it's all a question of, okay, do I become my own banker or do I buy an investment? Do I become my own banker or do I buy crypto, right? In this scenario instead is that you can do both. Because you can generate a high rate of return unless you control the banking function of your life, right? So essentially what we have to understand that when it comes to becoming your own banker, if we're not going to start, the introduction talks about the fact that it's how we capture all the interest that we pay to banks and financial companies for the things in our life, such as what? Automobile, education, appliances, right? It could be also for business expenses. It could also be for home and investment, right? So it's all about the how we finance things in our life. And we'll show you exactly why that's important, Okay. So how do people manage their money usually?
Yeah. So let's go through a little scenario of how most of us manage our money. Okay. Let's say most of us. So you have income that comes in, and then that income gets deposited into your checking account, right? You work, you make money, goes into your checking account. Then from our checking account, what do we have? We have fixed expenses and we have variable expenses. Fixed are like mortgage, car payments, things that are fixed. Variables like my vacation, groceries. Groceries go up and down depending on the week. So variable. Then most people go have debts. So we're paying off our debt from our checking account. Then we're paying taxes. So if you're self-employed, you're paying taxes, or maybe you're paying taxes like school tax, house tax, all those things come out from there. And then assets. We take our money and we deposit into assets that generate income. Well, it could be RSPs, TFSAs, right? So that's how most of us manage our money.
Now let's take a look at basically now what the money goes usually, right? So about 20% of the money goes toward paying some sort of automobile. And then about 30% goes towards paying the mortgage. And then 40% will go towards our living expense, right? We have to feed ourselves, take care of the kids, go on vacation. That's our lifestyle, right? And then if we go steward of our money, then normally we'll put about 10% aside for retirement. And that could be either saving for RSP, TSFA, it could be investment, it could be decide also to buy our own business, right? Now, the entire conversation when it comes to financial planning is all focused about here. What am I going to do with my savings? And that becomes a chase about where I can get the highest rate of return, right? So all the conversation focus on the 10%. But what about the other 90% of where my money goes? So would it be important to understand what happens to 90%? So what we realize at the end is that the 90%, we also pay interest on it, right? Think about it. Now, I'm not talking about the interest rate itself. I'm talking about the total volume of interest you pay over your lifetime. Now, we all know that if we finance a mortgage over 25 years, we probably end up paying about 90 to 100% of the value of the house after 25 years. And we realize at the end of the day, I'm paying about 35% of my money towards interest to the bank. What's the relation between the interest I pay versus the interest I'm earning? I'm making one step up and 3.5 steps back. So that's why unless you control the banking function of life, it doesn't matter the rate of return you generate over here. We have to understand how we control the interest we pay over there first, before we can maximize the return. Now think about all the money that have flown through your hands and your family's hands up until this point. What does all end up? We finance everything we buy. So it's important to understand also that as whoever controls the banking function of your life, which is the bank, makes money controlling that function.
So Jay was talking about the money that you spend in interest. And like he said, it's about the volume. Now let's look about the money that we're saving. All our savings, the reason why you're investing is why? Because we want to make a return, right? And we talked at the beginning that everybody's trying to make a quick buck, right? Trying to get the best stock or the best cryptocurrency to get your money to go up. But it's not about that. Investing is long-term. So what we have here is what we call the true cost of interrupted compounding. So this here that you see is called the wealth curve. So it's basically money that you've invested. So let's picture this. Picture, this winter with all the snow we had, right? We all built a snowman in our life, right? So how do you build a snowman? You start with a small snowball and then you roll it until it becomes the body of the snowman, right? So that rolling is compound interest. We'll call it compound interest. So it's like money. The snow that sticks to that ball is compounding interest. And if you invest money for 10, 20, 30, 50, 100 years, this is what you would see. But what do we do as Canadians? We do this. We start saving and then we're like, oh, we want to buy our first car. So we withdraw the money we saved and we crush the snowball. Then we save in our RSPs because why? Because we can do un rap. We can do the first time home buyers plan. So you've saved $100,000 and then we withdraw $60,000 for a wrap and we crush the snowball. Children's education, we put in RESPs, that goes up, they go to school, we withdraw the money, back to zero. And it continues on and on and on like that. And so Canadians are never on the wealth curve. Why? Because each purchase that we do deprives us of a return in our investments. Could we use our own money without affecting the return? What do you think? Well, we're going to introduce the infinite banking concept.
Everything starts with money, right? So whether you're an employee, you're on a paycheck, whether you're a business owner, at the end of the day, you have money coming in every month, right? Now with this money, there's only 4 things you can do with it. I can save it, I can spend it, I can give it away, right? Or I can also decide to invest it. Before I do all this, now we agree that we're probably using 100% of our money, right? There's no extra money most of the time, right? All our money goes to one of those four categories. So the idea is not to create an extra expense. Instead, what if we take a percentage of that money and redirect it to our own personal bank? And then what if instead you start depositing money in that saving account if you want and start earning 6%? And 6% consistently also. Because in this case, what we do is that we put this money into a contract with an insurance company that has been in business for over 100 years. Plus, you can also access the money and the money grows also guaranteed growth because you get dividend every year. And the money grows also tax-free. And then you also have control. And control is very important because the beauty about this is when you put the money inside those contracts, you are the owner of the contract. The insurance company is simply the administrator of the contract. Now, the beauty about this also, those contracts, is that you can borrow against it, which means, just like the bank using your money to lend to somebody else, now I'm going to use the money from the insurance company instead and make sure my money grows all the time, right? So you can borrow up to 90% at your will, okay? Plus, we'll talk about insurance, so that means you have protection in terms of that benefit and also credit protection, which means if you're self-employed or an individual, let's say someone tries to sue you, well, guess what? They cannot access the money inside the contract. Why? It's private property, which is important, okay? Also, because you're not connected to the market, there's no volatility. That means no loss, ever, okay? What's the Warren Buffett number rule when it comes to investing?
Don't lose money. Yeah.
Don't lose money, okay? What's rule number 2?
Don't forget.
Rule number 1.
Remember rule number 1.
Yeah.
Very good, right? And then because you have access to money, now you have access to money to opportunity, either to finance things in your life, right? Or to purchase your big purchases, such as a car, right? The kids' education, your house, or business if you want, right? Now, how does it work? Well, it's kind of like a mortgage if you want, right? So if you're familiar with home ownership, typically you make a payment at the bank every month. You start to as you pay down the capital, right? You start to increase your equity. This is a portion actually that we own, right? Now, technically, to access the equity of your house, there are only 3 ways you can do it. Either you sell a house, so you contact a broker, right, to sell your house. You can also refinance at the bank, or you can also ask what we call an ELOC, home equity line of credit, okay? Typically, you get access to 65 to 80% of the money based on the value of the equity. Now, how many of you have ever asked for a loan at the bank? Or they tend to ask a lot of questions, right? What's your income? What's your expenses? Show me credit score. What are you gonna do with the money? When are you gonna pay me back, right? Because remember one thing, right? The reason why the bank lend you money, because they want the payment every month, right? Because your expense is their passive income, okay? So that's important. Now, once you access the money, obviously, then you can do it whatever you want. You can use it for remodeling your house. You can go on vacation, whatever, right? Now, the private family bank works similarly with a few advantages. Number 1, you own the asset, okay? Plus, that asset is guaranteed to increase in value, which means the equity inside your policy is guaranteed to increase year after year without interruption, okay? But more importantly, which is the third part, and this is where becoming a banker becomes more interesting, there's no scheduled repayment. You choose when you can actually repay back the loan, right? And that's the key here.
So there's really only 4 people in the financial play, we'll call it, the theater of finances, right? And so depositor, borrower, banker, and bank owner. Do we all agree? That's the 4 roles that we have. We will always only ever be the depositor and the borrower. We can never be the banker or the bank owner, right? We can't open our own bank, or can we? Well, that's what Nelson Nash was talking about. How do you become your own bank? Because when you own a policy that we designed for infinite banking concept, you are the depositor. You're the one who makes the contributions to the policy. You're the one who borrows against your policy. And you're the banker because you decide when you're going to repay your loan to yourself. Mm-hmm. And you're the bank owner because you get dividends, as we saw in the previous slide, on your policy. So how does that work?
Mm-hmm. So the contract we use is something called a dividend-paying whole life insurance, right? But specially designed for high cash value. This is probably something you've never seen before, because only 0.25% of policy in Canada are designed this way. Actually, only people from Nelson Nash Institute, which we're part of, know how to design it properly. So what we do basically is that we basically reduce the cost of the benefit to increase how much cash you put inside, right? Because what we don't want necessarily that benefit. What we want is access to the cash, right? That's what matters the most at the end of the day. So once we put the money inside, we don't capitalize the money as similar to as if I put money to my saving account, right? But the beauty, once the money's inside, it can never go down. It can only go up. Because you get every day, you get dividends every day coming in, right? Now, to access the money, you have access to what's called the reserve of a mutual life insurance company. Why preferably a mutual company? Because all the policy owner of that type of contract become the co-owner of the insurance company. Hence why you get dividends, okay, as an owner. Now, to access the money, we're going to do what we call a policy loan. What we do basically, we're not borrowing our own money. We're going to borrow the money from the insurance company instead, so that our money can continue to grow all the time. And you can borrow up to 90% of the amount you have inside your contract. You know, we use the term, use other people's money. We're going to use this time the insurance company money instead, while we let our money continue to grow. Now, the beauty about this is that when we ask for a loan from the insurance company, they're going to ask you only one question and one question only. Do you want a check or direct deposit? That's it. Now, how's that possible, right? How can you just ask for one question only? Because the money's in collateral. They have the money. And secondly, if let's say we have an agreement, I'll lend you money to her. What's your name again? Manon, Jean-Pascal, enchanté. What's the worst that can happen to my money if I lend it to her? If she passes away?
Or that.
Right? Yeah. So the biggest risk is taken care of. Why? At the end, if she passes away without paying me back, guess what? Now I owe her money also. Because I have a debt benefit that I owe to her earning. You understand? That's why the insurance company is willing to lend her money without additional guarantees. Because the biggest guarantee is their own life. And plus the money is already in collateral also inside the policy. Now the beauty also is that now you can also decide to repay the loan at your own pace also, right? Be a good banker. It means if you borrow money from the bank, you want to pay it back, right? If you borrow money from your own personal bank, make sure you pay back also, right? Now, when you pay a loan back to a bank, who benefits from the transaction? Usually.
Yeah, the bank. She said the bank.
The bank, right?
Closing fees and everything.
Exactly. Now, if I borrow money from my insurance policy, who benefits from the transaction? Actually, all the owners of the participant in all the contracts, all the co-owners of the company. And that's why you get dividends also. So you participate also into the profit of the insurance company.
So today we focused mostly on individual, that like what we're showing is individual, but this strategy also works inside incorporations. So if you have an incorporation, if you have a business, we even have massive tax advantages that this strategy can do for your business. So we're not going to talk about that today, but if that's something that you're interested in, we can talk about. So what are we talking about is basically most of us are going through life like this, saving money, withdrawing it, saving, withdrawing, saving, withdrawing. We're constantly doing this kind of transaction or paying interest the other way, because then it can go the other way.
Yeah.
So we borrow and we pay back. We borrow and we pay back. That's the typical way that we go. But what we're doing here is we're creating wealth by staying on the wealth curve. We stay on the wealth curve over the years, and we're able to access the money to purchase our vehicle. So we borrow the money to purchase our vehicle from our policy while the money continues to grow, and then we pay it back. We can do a borrow for our first-time home buyers. We borrow the money from our policy, and then we pay it back. We want to finance the children's education. We borrow the money, and then we pay it back. We want to buy a revenue property. We have access to cash so that we can put a down payment on our revenue property and then pay it back. And then we even have money for retirement. But guess what? What is the number one fear of people when they get to retirement? Not enough money. Yes, we're going to run out of money. But guess what? We're on the wealth curve here, so we're not going up. And because we're not withdrawing money here, we're going to borrow against the value. And guess what? At retirement, it's the only time in this concept that we say don't repay the loan. because we're close to the end of life, and now we can take advantage of withdrawing all that money out of the policy or borrowing against the policy, because then the death benefit will take care of our debt at that time. So now we don't have the fear of running out of money because we're controlling the banking function of our life. So if we're doing this, if you do this, who are the number one users of this type of insurance? The bankers. Yeah. Let's talk about that. What does the bank do? So these are American banks, and we're going to see you have Bank of America. And basically what they do is they buy BOLI. What is BOLI? It's called bank-owned life insurance. If you look it up on Google, you can find it. They'll talk all about it. And actually in the US, it's actually more clear how much money they put into these policies. And you're probably saying, well, how does a bank buy life insurance on themselves? Well, they don't buy it on the bank. They buy it on the heads of their executives and key people in the bank. Why? Because you need a life to insure. So they put these policies on these key people and executives of the bank, and they stuff all the profits inside these life insurance policies. And so why do they do that? Because in order to lend money to you, they need to have money in reserve, right? Because if you have no money, you can't lend it out, right? So they need money is in reserve. So the bank needs tier 1 capital, high level of reserves in order to lend the money out so that they can lend it to you. And you can see here that look at how much money they have in bank-owned life insurance. But guess what? Because we work in a banking world called fractional reserve banking, they can lend up to 10 times the amount they have in tier 1 capital to you. So how much money can they lend out here? So Bank of America, $240 billion they can lend out. And how much interest rate do they charge you? Anywhere from 6 to 20%, even 30%, depending on the credit cards that you have. Because it's not the Visa that charges you the interest, it's the bank. So imagine how much money, why the banks are so profitable then. Because they understand the value of lending money and making money on that interest. They're just leveraging money. Yeah. And it's so lucrative that they actually put a cap to having 25% of your money in a vehicle like this. That's how lucrative it is.
Yeah.
So, but if the banks do this, what is it that the people don't know about life insurance?
Because keep in mind, one thing you understand when it comes to bank, don't do what they tell you to do what they do. Right? Then you get the secret.
So traditional financial advice works like this. We're all trying to build our financial house, okay? We'll call it our financial house. Well, your financial house needs to have a foundation as well. And in this case, it's your income. It all starts with income, because if you're not making any money, then you can't do anything. You can't buy a house, build a house, you can't even invest. So income is the foundation of your financial house. But there are 3 threats here that come and destroy your foundation, right? And that's premature death, sickness, and disability. Now, I know death, a lot of people are like, well, that's a long ways away from me. And the risk of it is very minimal in your lifetime. But what's the probability of death? 100%.
100%.
Exactement. On n'a pas une date qui nous dit quand on va passer. But why not prepare for it? If it's a permanent thing and we know it's going to happen, why are people not preparing for it? 1 in 3 Canadians will have a major illness, and it's cancer, stroke, or heart attack, okay? And we're not saying that you're going to die from it. We're saying that people survive these, because technology has gone a long way, right? But where's your income going to come while you're taking care of yourself? Because some of these illnesses may take 6 months to a year to reestablish yourself back in the income world. And then disability is about the same thing. And then debt. Debt is like a crack in your foundation, right? Debt, there's good debt and there's bad debt, but the bad debt's the crack. And the crack, if we don't fix it, we're going to have a flood. So we need to protect ourselves from that. Now, once we have a solid foundation, we're going to go more into details on the next slide. Then we use these 5 vehicles in Canada to create wealth. These are the common vehicles that most Canadians use to create wealth. And what does the traditional industry tell you? Well, you buy a house. Then once you buy the house, put some money in your RSPs, right? Maybe if you're a bit more risk adverse, you can put some non-registered, And then when you get to the bank, they're going to say, do you have a tax-free savings account? No? Oh, let's open a tax-free savings account for you, which most people don't even understand why they have one. But it is an investment account that's great. And then maybe just buy a little bit of insurance for your passing. Okay? That's the traditional way of financing. But how do the wealthy do that?
Yeah, exactly. And what's to realize at the end is that for them, it's not about locking the money inside the vehicles. For them, it's about accessibility, cash flow, and control. Because at the end of the day, we all want retirement, right? But what's necessary for retirement?
Money, yes. Why? Because when you retire, what? We're not working anymore, right? But where it comes down to is that really what retirement is a question of passive income. Either you have a business that's generating you passive income, or you have money saved enough to be able to withdraw that money so it can replace your income. That's how much money you need saved in order for you to retire with the same lifestyle that you have today. Now, by doing that calculation, most people arrive to a number of $1 million to $3 million a person. How many of you think you can save $1 million in your lifetime? Not many. As a
100% can.
Yeah, the Canadian statistics is 5% of Canadians are able to make it to that. The rest don't. So obviously there's a problem. So then why are we focusing on accumulation? If really retirement is a question of passive income, why not focus on passive income now? Try to find a way to generate enough passive income that's greater than your monthly expenses. Well, that's true financial wealth. And then it's not a question of age 65, it's a question of when that amount gets to that passive income, then you're financially free. What do we do as Control Your Wealth Financial is we focus on education. That's what today is about. It's about education. Understanding how money works. That's really important for you guys to understand. Then it's cash flow. Does anybody ever look at your cash flow? We know we have money coming in and money going out, but nobody knows where that money's going. I can guarantee you that. So we focus on that. We need to find out where is your money going. And then people forgot about savings. So our saving strategy is focused on the foundation of infinite banking. And then we can build the pyramid of financial success and get you to financial freedom. But there's some building blocks to get there. And how do those building blocks look like? Well, the first building block, we talked about the financial foundation. And it's all these things that you see over here. So we went over this: life insurance, health insurance, disability, debt strategies, how to get out of debt, damage insurance. So for your home, your auto, we all have that. We all have home and auto insurance, but a lot of us don't focus on this. Then asset protection. If you have assets, you need to protect those assets. And then trusts, wills, powers of attorney. Those are really important, and a lot of people overlook those. You can make $50,000 a year or $1 million a year in income. This foundation needs to be there. Why? Because if it's not there, the house crumbles. So we build the foundation according to your income. But why do people not focus on this? When I went through these topics, these building blocks, you probably were like, well, that's boring. Who wants a will? That's boring stuff. We want the sexy stuff. We want acceleration, investments, cryptocurrency. That's what we want. So we forget this and we go straight here, right, Jay?
Yep, exactly. So once we start to realize at the end of the day is that what we need is a strategy to save money. That's number one, right? Make sure your financial foundation is solid. Number two, then you also focus on now invest to cash flow. Because if I want to retire, as opposed to lock my money in a vehicle I don't have access to, because if I do, I get penalized, either in taxes or the value reduced, then why not just go to take my money, invest it right away for cash flow, and eventually read the number I need, right? But we have to be told how to do it, right? If the majority of the financial industry wants us to do it this way, and we tell you to go this way, people are, why these guys are going this way, right? But we tell them to go this way because that's what the wealthy are doing, right? And Warren Buffett said it on the best: if we just do what the wealthy do, we're in the same position. It's just that we don't have the education to do it, right? Today we have an opportunity to focus on it, right? Now, there's one thing, an element that's important for people to remember. As we build our wealth, eventually there's also an element that we always have to be aware of, which is the bank. Now, we're going to make you listen to a little audio here about the banking. Okay, I think it's very interesting when it comes to this. Okay, are you ready?
Yeah, go ahead.
Perfect.
in the British humor magazine Punch on April 3rd, 1957. It is included here as an appropriate introduction and as a mental exercise to limber the mind for the material contained in this book. Question: what are banks for? Answer: to make money. For the customers? For the banks. Why doesn't bank advertising mention this? It will not be in good taste. But it is mentioned by implication in references to reserves of $249 million or thereabouts. That is the money that they have made. Out of the customers? I suppose so. They also mention assets of $500 million or thereabouts. Have they made that too? But not exactly. That is the money they use to make money. I see. And they keep it in a safe somewhere? Not at all. They lend it to customers. Then they haven't got it? No. Then how is it assets? They maintain that it would be if they got it back. But they must have some money in a safe somewhere? Yes, usually $500 million or thereabouts. This is called liabilities. But if they've got it, how can they be liable for it? Because it isn't theirs. Then why do they have it? It has been lent to them by customers. You know, customers lend banks money? In effect, they put money into their accounts, so it is really lent to the banks. And what do the banks do with it? Lend it to other customers. But you said that money they lent to other people was assets? Yes. Then assets and liabilities must be the same thing? You can't really say that. But you just said it. If I put $100 into my account, the bank is liable to have to pay it back, so it's liabilities. But they go and lend it to someone else, and he is liable to have to pay it back, so it's assets. It's the same $100, isn't it? Yes, but then it cancels out. It means, doesn't it, that banks haven't really any money at all? Theoretically. No, theoretically. And if they haven't any money, where do they get their reserves of $249 million or thereabouts? I told you, that is the money they have made. How? Well, when they lend your $100 to someone, they charge him interest. How much? It depends on the bank rate. Say 5.5%. That's their profit. Why isn't it my profit? Isn't it my money? It's the theory of banking practice that when I lend them my $100, why don't I charge them interest? You do. You don't say. How much? It depends on the bank rate. Say 0.5%. Grasping of me, rather? But that's only if you're not going to draw the money out again. But of course I'm going to draw it out again. If I hadn't wanted to draw it out again, I could have buried it in the garden, couldn't I? They wouldn't like you to draw it out again. Why not? If I keep it there, you say it's a liability. Wouldn't they be glad if I reduced their liabilities by removing it? No, because if you remove it, they can't lend it to anyone else. But if I wanted to remove it, they'd have to let me. Certainly. But suppose they've already lent it to another customer. Then they'll let you have someone else's money. But suppose he wants his too, and they'd let me have it. You're being purposely obtuse. I think I'm being acute. What if everyone wanted their money at once? It's the theory of banking practice that they never would. So what banks bank on is not having to meet their commitments? I wouldn't say that. Naturally. Well, if there's nothing else you think you can tell me, quite so. Now you can go off and open a banking account. Just one last question. Of course. Wouldn't I do better to go off and open up a bank?
What do you think?
Yeah.
Amazing.
So, how do we start our own bank?
So it only starts with income again. So remember we went back to how people manage their income. So we have our money that comes into our active account, right? So we have active income, goes into our checking account. We have still our fixed and our variable expenses, correct? And we're just going to add an extra step, open up our own bank. So these variable and fixed costs are always going to be there. But there's that extra money that Jay was talking about before that we're going to redirect into your own bank before we go and pay debts, before we go and pay taxes, and before we invest in assets. Because then what the assets generate, we put it back into the bank. You're probably saying, I don't know, I don't understand how that works. Well, the point is that we can't explain it to you, and you're probably not going to catch it today because we only spent not even 45 minutes on this. And Nelson Nash used to do 10-hour seminars. So really what we want you to do is really pique your interest in how this works. And we're going to show you a little case study now on how this can potentially work. So here, they'll be able to generate an income of about $72,000 a year, okay, with no access to cash until retirement, because that money has to be saved and growing on to stay on that wealth curve, so we can accumulate $1.2 million so they can retire with that cash flow. On the other side, with life insurance, with the strategy, the infinite banking concept, we're going to put the same amount of money in. They'll be able to have $80,000 of after-tax income, but access to the cash during their lifetime so that they can purchase a house. Maybe they can help send their kids to education at school, for education, obviously at school. And guess what? We even have life insurance. This person will have over 800,000. They would have about 800,000 at 85, or 500,000 if they live to 90. So not only are they able to use money to have a retirement, they're able to use money to finance the things in their lifetime and be able to access cash for retirement and leave their children or their beneficiaries an extra $800,000. But you're probably saying, well, Anthony, but look, looks like it's less here than they put over here. Yeah, it is less. But they leave more money when they pass. They leave a heritage to their children, which most people want to do, right? Do you want to leave something for your children? Possibly. But you also want to have access to your cash while you're living. And so this opportunity gives you both to do both of those things. If somebody accumulated this amount of money, okay, and you pass away, the government is the biggest beneficiary of that money. Do you know why? Because the government wants its taxes on RSP. Because they gave you a tax refund today to get it at retirement. Now you're saying, well, yeah, but I have a spouse, so I will transfer to him or her. Fair, that's right. It will go to them. But let's say you pass away later, or you pass away together. Well, your family will be taxed 53% on that $1.2 million. 53% means the government is the biggest beneficiary of all the hard work that you put in to that money, and your children will only get less than half of what you put.
Yeah.
And over here, if that was the case, if you passed away, you had a life insurance of over $1 million.
Actually, $2 million.
It was a $2 million life insurance. So you would still have the RSP, which would be half of that, because obviously the government would take tax half, and then over $2 million that you'd leave to your children, if that were the case. So you see that we're already putting our position as a family in a better position than what we were over here. And so that's the key, is that you need to focus, because a lot of us say, well, when I pass away, people will take care of it. But that's the problem. You can't do that, because the middle class stays the middle class because they think that way. The rich or the wealthy are thinking 2 to 3 generations down the line. The Rockefeller method, if you've ever heard of that, that's exactly what they do. They don't plan for today or tomorrow. They plan for 3 generations down. So the infinite banking concept is not infinite banking or investing. It's infinite banking as you're safe and do whatever else you want to do in your lifetime. It's really a safe of your savings, because we've forgotten to save. Because most people, when they save, they're not really saving. They say we're saving, but we're not. And so how do you save, be able to grow your money in your savings and deploy it without affecting the savings at the same time and generating that investment that you're talking about? Because yes, you could get a bigger investment outside of the insurance environment, because we're not comparing it to an investment, we're really comparing it to a savings.
We always thought that you need to save for retirement. Well, are we really saving or are we investing for retirement, right? Because the two are different concepts. Because investing, there's a risk, right? All you do basically, you give the money to somebody else, which you lose the control with the expectation to get it back at a higher amount. But it's never guaranteed, right? Look at the market like recently. If you were to retire during that time of the year, guess what? You may have to push it back a bit, right? So, but instead, if we focus on saving, especially in an environment where I have control and accessibility, now it changed the game, right? And that's what we were basically introduced to a client. So what you have to remember, it's not about a product, it's about a process, right? Because people sometimes get caught up on the tool, the insurance the policy. The tool is not the concept, right? The insurance policy is only what we do to do the infinite banking, but the key behind it is how you control the banking function in life. That's where actually you'll be able to leverage yourself.
So we're coming to the end of the presentation, and what we want to talk about is what do we do? So number one, we're giving you financial education. That's number one. We want everybody to be educated, to understand, to be open-minded about things. Second, financial planning. Everything starts with a plan. We need to know what your goal is, because this is your plan, not our plan. It's really you. And then we're your coach, right? So coach like an Olympic athlete, right? So I'm here. You're the Olympic athlete. I'm coaching you. I'm telling you what to do to win the gold medal. Michael Phelps won the gold medal, not because his coach swam, but because he swam, right?
Yeah.
So that's the thing. So we're teaching you the concepts. We're teaching you how to get there so you can win the gold medal, but it's ultimately up to you to be able to follow us. And we do that by analyzing your cash flow, because like Jay said, everyone's at the maximum. We're not asking to add an expense to your budget line. We're looking at where is your money going today that we can redirect it into a plan that can help you implement an infinite banking concept through insurance planning, then moving that to investment. Whether you want to invest in the markets, cryptocurrency, you want to buy a business, you want to buy real estate, whatever that is, we're here to help you design your investment plan. And then with investments comes what? Growth. With growth comes
Taxes. So it's important to plan for it. And that's what we're going to help you too also. So we have a team also with the CPAs and accountants that can help you with the strategy too. But the end game is really to make sure that you start saving money with the purpose to invest, to create more cash flow. As the asset continue to grow, let's plan also potentially for a tax, right?
So we went through these on the last slide. We do work with a team of experts. We have CPAs, notaries, real estate agents through Berkshire Hathaway Home Services Quebec, and mortgage brokers to get you a good deal on your next mortgage renewal. And we can also talk about Manulife Bank. She'll be coming up to talk about the Manulife One product. So great. And we also offer a cloud-based secured personal vault. So how many of you had to deal with a succession? Not fun, right? Trying to find all the documents? Well, we have a program that we give free to our clients who work with us that allows you to put all the documents that you have inside. Okay, so you have access to it, because there is no website that you can go to when somebody passes away that's going to tell you where their assets are. You need to know where those are. So this will allow you to organize it and give access to who you want. You can give access to your lawyers, your notaries, your accountants, and even the person who is the liquidator of your estate, if you wish. And you can decide when to give that access and when to take it away. And it's all your personal documents. We give that free.
Yeah. So when it comes to infinite banking, some people will ask sometimes, well, how come I never heard about this before, right? And also it's like, which is normal. And some people also say, well, I wish I knew this 20 years ago, right? But one question you have to ask yourself, when are you ever going to stop depositing money in your bank? Never, right? So it's never too late, right? If anything happens, you're just going to leave more for the next generation also. Well, not only you benefit from it, from your living, right? Plus you also help the next generation get a step up also.
So we gave a lot of information today, and the key was to give you that education, and now it's up to you to digest it and see. But if you guys are interested in knowing more, well, number one, we recommend that you read the Becoming Your Own Banker book. It's the Bible to infinite banking. It'll really help you understand how infinite banking works. Then the next step is book an appointment with us. It's a discovery call. You're probably asking, this sounds expensive. Well, we don't charge anything. It's free of charge, and the companies that we do business with pay us. So you don't pay us anything. We create and develop the plan for you. We show it to you. If you like it, good, we move forward. If you don't, that's not a problem. But the discovery call is just really to get to know you and know your goals, and then we can move forward to the next steps. But really, these are the two next steps. You can scan the QR code to book a discovery call with us. It'll open up our calendars, and you can sit down with us, and we can discuss the next steps with you. And we want to say thank you to everyone for coming out this morning. We're going to take a break. We're going to have croissants and more coffee at the back. So take a break. Go visit our product, the Orange Theory Fitness Manulife Bank, if you want to get more information. And then after the break, we're going to come up with Sasha, Berkshire Hathaway Home Services, Manulife Bank. And then lastly, we're going to bring the star guest up for the thyroid health. Okay? Dr. Alexandro Zaruk after the break. So thank you so much. If you have questions, we'll be around. We'll talk. I think the key takeaway that we want people to leave with today is that to have an open mind. It's like jumping out of a plane with a parachute. The parachute, when it opens, it captures the air. Well, we want people to capture all the information that they have today and make an informed decision, and then move forward and have a different idea of how finances work and maybe how their health works.
Yeah, the biggest man, I would say it's really about the mindset. People have to be open about other possibilities, because we all know what we know, right? And then unless you're open to learn, do new ways, especially when it comes to money, especially when it comes to actually even for your health as well, how do we make sure that we optimal our results, right? So it's always be able to be open to understand what's available and have an open mind. Just like a parachute, you make sure it's open, right? At least you'll know exactly what's possible, and then we'll be there to guide you along the way.
I want them to realize that sometimes it's not just what you see on the surface in terms of information that matters, but getting someone that knows what's going on to be able to go to the right professional that will really guide them to the best of their interests. That's what they should be focusing on. You know what they say, that only a fool has himself for a client? And even though I know how to put a nail through a piece of wood, I wouldn't go out and build my own home. So sometimes it's good to get the advice of experts. So I hope they take that away today.
One thing that people have to remember Manulife One by is the amount of interest that they'll be saving, and that they would be paying off their mortgage and their debt much faster than any other method.
Most people will shop around for a rate, which is the biggest mistake they can make, because a rate will only be for a small period of time, whereas a mortgage product will last them for a lifetime. And like Bernie said, will save them a whole lot of interest.
Well, the presentation is a very fantastic one, and it's an eye-opener, especially on how we could be possibly prepared for our old age, because I've seen that in this present world, a lot of people, during their old age, they went through a lot and they are unable to protect their future. So with this presentation that I've encountered today has given me that eye-opener to have a future investment, whereby in my old age, I will not stress, I will not go through any hardship, whereby I will be able to make up with my finances, my planning, on mortgage, on vehicle, if I want to live longer. So this presentation is so fantastic and it's so lovely.
Well, my name is Dennis Papadopoulos. I'm here to represent Orange Theory. I think it's very important to be in health, and we'd like to be part of this to help everybody be healthy. And
Thank you, guys. Thank you very much, Anthony and Jay. By the way, great presentation before. I have the privilege of seeing them do their thing at the office on a regular basis, and I can personally assure you this was a very exceptional sample, but you need to really sit down because the detail is too immense to get into one presentation, right? So you guys did a great job. Also, I think it's fantastic that Orange Theory and Manulife are next to each other. So you go to Orange Theory, you get a heart attack, boom, you're insured because Manulife takes care of your family afterwards. I had to. So I'm not going to kill you with PowerPoints. I'm just going to give you a little bit of a CV of where I come from. So I've been in real estate for over 20 years. I do not sell real estate today. I own a company. I own the rights for Berkshire Hathaway Home Services for all of Quebec. Yes, we are a direct branch of Warren Buffett's Berkshire Hathaway Inc. I actually had to get approved by Warren and his team personally before acquiring the rights for all of Quebec. And I've had the privilege of speaking to the man twice in my life. So I'm sure it was a lot more meaningful for me than it was for him. But before getting the reins of Berkshire Hathaway, I used to run another international real estate company for all of Canada, and I am still very involved in different councils for real estate, not just in North America, but in Europe as well recently, particularly in Italy. Real estate is not something that is so specific that what I tell you is the only version. Everyone's needs are different, everyone's budgets are different, everyone's preferences are different. I am going to do a lot more focusing on what happens in the province of Quebec, because that's where we live. So when we talk about real estate, and particularly in residential, because there's residential and commercial, they operate very differently. The transactioning of them is very different. The requirements to purchase either of them is very different. And the functionality of them are very different. So we're going to talk about residential real estate, because when we think about what they've presented to you and the usage of your home to help you build wealth, we talk about the residential aspect of real estate primarily. We have a blessing and a curse when it comes to Quebec real estate. The blessing is that we are a French-speaking province with very strict French rules. The real estate in Quebec, because we are a French province, has always allowed us to have a very stable increase in our markets. We're not like Ontario and Vancouver, where I call it the defibrillator. It goes like this, peaks really high, and it drops really low, and then it comes back up, and it's dependent on how many people are coming in for work. It's dependent on how many people from outside the country are coming in. There's so many factors. In Quebec, we're very happy. Okay, better or for worse, for better or for worse. We have l'Office de la langue française, okay, fine. And you know that you're not going to move here unless you're willing to adhere to all of the criteria for the province of Quebec. So it might be more expensive to live in the other provinces, but you know that when you come and you move here, we like our little stable 5 to 7% increase a year because it's comfortable, making real estate a very safe investment. Historically, two things have crashed the real estate market in Quebec. Separation, or should I say fear of separation, which is unique to us and to us alone. And number two, the stock market, which is a worldwide effect, and quite frankly, we have no control on it, so it is what it is. So that's why it's a blessing to be in Quebec. And I know a lot of people that unfortunately have to adhere to the French rules in this province laugh at me when I say that, but truth be told, it's one of the greatest factors in the stabilization of our real estate market. The curse that we have in Quebec when it comes to real estate, and then again, it brings me back to my Quebec family name, so please don't hate me, is that Quebecers or residents of the province of Quebec unfortunately have a very different mindset when it comes to making money, investments, and there's a lot of entitlement. A perfect example of that entitlement was the recent Amazon departure, where Quebecers basically said, well, we have a right to be syndicated. Okay, but if you're going to exercise your right, make sure the guy you're exercising them to has lesser rights than you do. Because they just turned around and said, okay, congratulations, we can leave. And now they're all up in arms, mais c'est nos droits. And they're like, I don't care que c'est ton droit, c'est mon droit de partir. So basically, that mentality in Quebec is been very challenging from a residential real estate standpoint. The sellers in Quebec, in comparison to all of the other provinces that I've had the pleasure of operating in, sellers in Quebec have a very high perception of the real estate that they own. They're very proud of it. Mine is better than everyone else, and my price should be this because I believe that mine is better than everyone else. So the entirety of the real estate market is based on supply and demand. Right now, today, as we speak live, it is a 100% seller's market. Why? The inventory is exceptionally low. Every article that's been coming out about real estate recently has stated very clearly that out of the 4 major cities in Canada, Montreal is the only one that is expected to see 6.5 to 7.5 annual increase in the real estate values, only because the inventory is so damn low and there are so many buyers waiting to jump onto the market. COVID sort of took what was naturally happening and gave it an injection. So for example, on everything, the Bay is closing their stores. By the way, great linen sales. I was there yesterday. Go there while you can. The Bay closing their stores is one example of retail dying much faster than it was naturally because COVID forced people to come and buy online because they said, well, this is the new reality. Okay? Real estate with COVID ended up going during 21, 22 21% increase. But then all it did is it adjusted itself by 17 in Quebec. So what do we end up with? Our regular 4 to 5% increase that we've had before. And the reason for COVID, I was going to get to it later, but I'll say it now. The reason for COVID creating so many bidding wars was because COVID made people realize a few things. For some reason, they couldn't see past it. They said, oh my God, I'm never going to travel again. I need a house that has a big backyard. I need a pool. I need a this. I need a that. Well, God ain't making any more land. And then you've got the guy selling who says, yeah, but if I sell, where am I going? So again, we had a huge demand, but a small inventory, and it caused all kinds of problems. It inflated the market. Prices went higher, as you said so very well, multiple offers. Some of the offers were being done with no contingency. So the guy buying never did an inspection, waived his right to it. The point is that the buyer was forced to be said, as I said earlier, I might have desires and rights and wants, but unfortunately, I'm not going to get what I want unless I'm willing to go to the extent, right? So that's what happened. But today, because of the low inventory, regardless of price point, one of my agents at Berkshire just put a house in Pierrefonds at $650,000. Day one. He got 3 offers on it, not even seeing it. The visits are scheduled. And he still has, knowing that everyone knows there's 3 offers, he has another 7 visits on it tomorrow. So this house is probably, I'm guessing, j'ai pas de preuve, I'm going to go with my professional assumption that it's going to sell around 700, 710,000. So proper pricing in a market where demand is greater than supply, you're always going to have multiple bids. Correct. As long as you listen to someone who is a professional and you price it properly. And I will tell you guys a trick, and I do it myself. For my own homes, when I say myself, not because I have clients, just for my own properties. My last house in El Bizarre, that I lived in before I live where I live now, I was told, I brought in a few of my guys and I said, give me a price, an honest to God price. And they all came between give or take. The lowest one I got was $950 and they said about $1,025,000. I said, excellent. I put it on the market at $940,000 and I sold at $1,075,000. Because the market is not stupid. People see things, they know what the values are. Don't think that buyers don't know. They know. There's a reason houses sit on the market. It's not because of the bad marketing. It's not because of the agent. The sellers, they like to blame the whole world. Oh my God, a black cat ran through my garbage. My house isn't selling. No, it's all price. Don't kid yourselves, okay? I know that there's a lot of misinformation put out there from real estate agents and real estate firms, and they have all the answers. My favorite lie is interest rates are low, it's time to buy. In 1980, interest rates were 20% and people were selling. In 2 years ago, interest rates, you were at 5% and mortgages were at 7%, and we still got a 6% real estate increase. So sorry, it's not about that. It's all about price, and the price at the time that the property is put on the market. We don't have crystal balls, right? We don't. Nobody in this world has a crystal ball. Jay and Anthony can show you how to do. This is probably one of the most secure investments you can make, the infinite banking, because it's got a proven track record. But I'm very invested in the stock market. I don't do trading of companies. I do indexes, S&P 500. I like low and slow. You know, look, I'm a big guy. I need to go to Orange Theory. I can't move fast. I need low and slow, but I need secure. But the problem is, it's like in real, nobody can tell me tomorrow what is the S&P 500 going to do. Nobody predicted that when Trump started to do all these decisions. I mean, all of you in the stock market, you can see it's been a very stressful ride. Real estate's the same thing. All of the information is based on past sales, comparables. What was this sold for? But then you have to read a little bit further than, as my father would say, pense un peu plus loin que ton nez. Okay, there you got that info, and now you see the current trends of what's happening. That combination creates what the price should be. If 3 weeks comes and you don't have a visit, well, I'm sorry, it's not the pictures, it's not the marketing, it's your price. That's all it is. It's all a question of price. So all of these factors in the province of Quebec right now is making real estate quite interesting. The fact of the matter is interest rates will not play a huge factor on the purchasing power of real estate if you're a buyer. You might think that 1% less on your mortgage means something, but I'm sorry, when the house is going up 6% per year, what did you gain by waiting, thinking the interest rates were going to come down? All it means is that you're able to buy it at last year's price. Congratulations, it's up 6 points. So quite frankly, the reality is there's not a specific mortgage amount that makes a difference. It's not because you signed at 4.5. Yeah, you know what? Sorry, in a year from now, it might be 4.2, it might be 4. It might go back up. it's the luck of the draw. You don't know. But the point of the matter is, when you're buying real estate, the best time to buy is always now. This whole I'm going to wait game, if I hear anybody ever tell me, well, the market's going to go down, I'm here to tell you, no, it's not. It's not going down. Well, I'm going to find a deal. There are no deals in real estate. There is fair market value for the product that is being offered. I am telling you now, mark my words, there are no deals in real estate. I am a 43-year-old mortgage-free homeowner with investments. I can assure you there are no deals in real estate. So don't ever think that there's a deal. Your friend tells you they got a deal, your friend is lying to you. They should no longer be your friend. You should invite me to your house instead. The best time to sell when you're ready to sell is now. What happens if this Trump situation increases the amount of uncertainty you guys currently are seeing, both on the investment standpoint, real estate, and so forth? Well, I'm sorry, those buyers that are in such high demand to purchase right now are going to say, hey, maybe I'll rent and wait. And then this idea of you potentially getting multiple offers or having that huge bank of buyers coming to your home won't be there. So again, sellers need to understand that the time is always in the present if the conditions are in your favor. And I keep stressing that. We have one of my agents here, Evan. He's an agent with Berkshire Hathaway. And I send emails regularly to the whole team. And I say, guys, tell your sellers, don't wait. The time to make a move is now, because it's less money in their pocket if they wait. At any point in time, real estate is always a very safe investment. Like any good investment, and like Jay and Anthony mentioned so very well, talking about Warren Buffett and the idea of, over time without rushing. Rushing is never good. The right real estate purchased at the right price is good as long as you keep it for the right amount of time. There's no crystal ball on how much that amount of time could be. COVID screwed it up. You bought something and all of a sudden a year later it was worth 200,000 more. Nobody could have predicted it. In normal times, real estate, if you have a single family home, you have to keep it for at least 2-3 years to see something come out of it, a profit of any sort. Condominiums are very, 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 very touchy because you're only as good as the last price per square foot. So when you buy a condo, you better make sure that you buy it, keep it for 5 years, and please do not buy the stupidity of the smallest condo in the building because you think it's a deal. You're shooting yourself in the foot. But also understand that this is an asset that you're going to hold on to for a particular amount of time, depending on what it is. And then again, in your meetings with Jay and Anthony, understanding how to, quote unquote, milk that asset to get as much money into it to then put into investments and to grow your portfolio. Warren Buffett has said that, someone is getting shade because somebody planted a tree so many years ago, and that's the truth. Patience in this game is key. Investing in any way, shape, or form, real estate especially, is key. You're very fortunate, unless you're going back to Vancouver, you're very fortunate in Quebec that if you buy real estate now, I can assure you it's a safe investment, and I say that to you from someone who is doing it and has done it. It is a very safe investment. But there are no easy ways, okay? All these TikTok videos that you see, get rich by tomorrow, do this and money will come flowing your way, they're all lies. I'm telling you, they're all lies. There is not one millionaire that I personally know that will tell you that everything was done within seconds. It's not possible. Buy real estate and wait. Do not wait to buy real estate.
Hi, it was amazing, awesome, I love it. Every time I'm here, for me, it's really interesting, because as an agent, always I would get more information, and I'm so happy because now I think everyone likes to get more information about infinite banking, about health and wealth. I love it, and thank you, everyone. It's really hard, it's Saturday morning, to get up and join us, but I love that.
I even bought the book. Fantastic. I bought the book because, not for me, I'm pretty set. 7 years I retired, I'm good. But for my sons.
Perfect. That's what we need.
Yeah.
Okay.
So this is information that's reaching, several generations. How do you feel about that?
I feel great because that's what we said. What did we say in our presentation? We need 3 generations of...
Yes.
So would you say that you came here not only for yourself, but also for your
future generations? For my kids and my grandkids.
Yeah. That's a beautiful thing.
Yes, especially the food part. For the grandkids.
Sérieusement, c'était très... il y avait beaucoup de nouveaux insights, beaucoup de nouvelles informations. C'était très clair, très concis, très relatable. En tant que... Moi, j'ai une entreprise, je suis self-employed. C'était très pertinent pour moi, mais c'est très pertinent pour d'autres personnes qui sont salariées, peut-être employées. C'est un très bon concept. Nous, on l'applique déjà activement avec Jean-Pascal et Anthony. Donc, c'était bien de refresh la mémoire sur certaines choses. Puis c'est sûr que c'est le fun de voir le concept se répandre un petit peu, puis voir d'autres personnes aussi bénéficier de leurs infos.
De webinaires comme ça auparavant sur l'infinite banking, c'était bien. Ça nous fait un petit refresh, c'est bon de temps en temps. De relire le livre aussi de Notre, qui est super intéressant. Puis je pense que c'est un concept que les gens devraient plus connaître. C'est pas assez connu encore, surtout au Québec. Je pense que comme à chaque fois qu'on parle de ça à quelqu'un, il sait pas c'est quoi. Fait c'est vraiment c'est un beau concept. C'est fun.
So I'm Alexandre Zarouk, trained in internal medicine, got certified in integrative medicine, got certified in functional medicine, and also right now doing my American board of lifestyle medicine. I think thyroid health is being neglected in today's society. We don't realize how this master gland is involved in everything, whether it be mental health, physical health, hormonal balance. So this is why I wanted to talk about it at this event. And I also believe that in this event where we're trying to educate the layman person in regards to wealth management, I wanted to actually bring some education aspect to it. In regards to something that has such a great impact in someone's life. So thyroid health and wealth, right? Or well-being. I'm gonna say energy-wise, you're gonna probably be able to work longer, work better, less presenteeism, less absenteeism, probably also better mental health clarity in thought process and making decision, for example. If you're unwell, ask for help. We do it in a lot of things. We do it for our kids. We do it for our parents. We're doing it also for wealth management. And I'm asking you, if there's a lack of energy, maybe some brain fog, some poor cognition, some poor sleep, ask for help.
Oui, on est très content. Qu'est-ce que tu en penses?
J'ai aimé vraiment seulement le fait que les gens étaient là, ils ont aimé l'information, on a eu beaucoup de commentaires positifs également aussi. Ils ont adoré l'aspect au niveau de la thyroïde, parce que c'est un sujet que les gens ne parlent pas souvent. Fait que le comprendre entre la relation entre la santé et la prospérité, ça fait toute la différence.
Ah oui, puis moi j'ai eu quelqu'un qui m'a dit qu'il venait spécifiquement pour la santé de la thyroïde, puis il a dit je savais pas que vous alliez parler, puis j'ai beaucoup aimé que j'étais là pour votre présentation.
Alors restez en contact. On a bien sûr le poste numéro 2 qui s'en vient au mois de septembre. Et là-dessus, control your wealth.
Merci.
Control your wealth, take the reins today.